We've all heard of Warren Buffett's successful investments in companies like Coca-Cola, American Express, Apple, Bank of America, Moody's, Kraft Heinz, etc. In addition to being this brilliant investor, Buffett, through his letters, annual shareholder meetings, interviews, etc., has graciously shared his learnings with millions of people all around the world. In fact, one of my favorite quotes from the Buffett School of Wisdom goes something like, "While it's good to learn from your mistakes, it's better to learn from other people's mistakes." And so following his advice, in this video, we shall examine 7 big blunders that Mr. Buffett has himself made and what are the lessons that we can derive from it. Let's begin. Warren Buffett called Berkshire Hathaway's 1993 purchase of the Dexter Shoe Company as the worst deal that he had ever made. Actually, he had made not one but 2 big mistakes in the process. The first one was a miscalculation of Dexter's prospect. You see, while Berkshire bought Dexter on account of its high return on capital employed, what they didn't account for was the competitive threat that the company faced with cheap shoes being imported from countries like China. Buffett made a note of this in his 1999 letter, where he wrote that it was becoming extremely difficult for domestic producers to compete effectively in the shoe business, with approximately 93% of the 1.3 billion pairs of shoes that were purchased in the United States coming from abroad. So lesson number 1 is, for any company, having a durable competitive advantage is no longer a good to have, but it is now a must have. The second mistake Buffett made with the Dexter shoe deal is that it was not purchased using cash, but with $433 million worth of Berkshire Hathaway stock. Now, one share of Berkshire's Class A shares was around $15,000 in 1993. And is today valued at $517,000, which means the Dexter move did not cost Berkshire shareholders $433 million for a company which came to be worth nothing, but in fact that mistake of paying for it using Berkshire stock actually costed the shareholders of Berkshire a princely sum of $15 billion. Of course, the lesson that we can draw from this is that never sell your winners in order to make risky bets. Tesco is a UK-based grocery chain, and by 2012, Berkshire Hathaway was owning more than 5% of the business. By 2013, it was getting apparent that something was wrong with Tesco, and Berkshire had pared down its stake to 3.7% by then, although it still represented an investment of nearly $1.7 billion. Over the next few months, Tesco's share price continued on a downward spiral, having fallen by almost 50% on account of declining sales and increased competition from discount retailers. During the same time, Tesco also issued a string of profit warnings, and if that wasn't enough, there was also an accounting scandal, and the company was put under investigation by UK's financial regulators. Now, Buffett's mistake in the case of Tesco was that he delayed the sale of Berkshire's remaining stake of 3.7% in spite of having read the signs. In his own words, he kept on dawdling, a delay which costed Berkshire to the tune of $444 million in losses. The lesson for us here is that conviction is key to investing. Simply said, don't invest without conviction, and likewise don't hold onto a stock if you don't have any conviction in it. Warren Buffett rarely makes investing decisions without consulting his partner Charlie Munger. But as was revealed in his 2013 letter, his $2.1 billion purchase of Energy Future Holding Corporation was one such instance, which also turned out to be a $873 million mistake. You see, Energy Future Holdings relied on coal-fired power plants to produce electricity, and Buffett's purchase of their high-yielding bonds in 2007 was a bet that the price of natural gas would rise, making the coal-based business a lot more competitive and profitable. But as luck would have had it, the price of natural gas actually plunged from its 2007 levels, causing massive losses to Energy Future with the company ultimately declaring bankruptcy in 2014. At the end of it all, Berkshire sold the $2.1 billion worth of bonds in 2013 at a loss of $873 million. Warren Buffett humbly declared that he had miscalculated the gain-loss probabilities of the transaction and cited a lesson that it is always good to get a second opinion from a business partner or a trusted confidant when taking big decisions. In our view, there are a couple more lessons that we can draw from this episode. The first is the value of predicting, which for something like the price of natural gas or oil or gold or even an individual stock can be very costly if you end up in the wrong side of the transaction. Now, this might sound a little counterintuitive, but the point I'm trying to put across here is that as investors, we have to start putting more emphasis on evaluating and growing one's wealth as a portfolio rather than individual and disparate assets. If this makes sense to you, then do explore ET Money Genius, which works around 6 different portfolio strategies, and the detailed explanation of which is available in these videos, which are available in English and Hindi on this YouTube channel. A second lesson we can gather from the energy future holdings mistake is the utility of purchasing high-yielding junk bonds. You see, Berkshire Hathaway is a huge conglomerate and it can afford to lose some money in pursuing such high-risk, high-return opportunities. However, for retail investors like you and me, a default like this can be financially disastrous, and in that context, do try to stay away from instruments where the return on capital is highly questionable. In 2011, Warren Buffett and Berkshire Hathaway came under fire when it was revealed that David Sokol, who was the chairman to many Berkshire subsidiaries, had pitched Lubrizol Corporation to Buffett as a potential takeover target while owning stock in that chemicals company. Mr. Sokol's non-disclosure of the stock's ownership to Buffett was in violation of Berkshire's insider trading rules, and while Berkshire bought Lubrizol for roughly $9 billion, David Sokol also earned some $3 million in profits from this transaction. Berkshire's internal investigation into the matter revealed that Sokol was deliberately vague on how he came about owning the shares of Lubrizol and had not articulated that he had bought the shares only after meeting the bankers who had initially come up with the acquisition proposal. In Buffett's own words, it was a matter of simple ethics, but it's a statement that came only after initially admitting that no one was at fault there. In our view, David Sokol and Warren Buffett both made mistakes, and the investing lesson to follow here is not to be overly trusting. So have a checklist, follow a process, and don't hesitate to ask more questions than what you think is necessary, because when it's your reputation on the line, you just can't afford to take it easy. The mistakes we have seen so far were all errors of commission, but here's one that qualifies more as an error of omission. In 2017, Buffett admitted that he had followed Amazon.com for a long time but never chose to invest in it. In his own words, he said, "I was too dumb to realize. I did not think Jeff Bezos could succeed on the scale he has." Essentially, Buffett had underestimated the brilliance of Amazon's execution in not one but 2 industries, that is, the company's dominance in e-commerce and its success in the cloud with Amazon Web Services. When Berkshire did make a $1 billion bet on the Amazon stock in 2019, the decision came from one of Berkshire's investment managers, although I'm pretty sure it still came with Buffett's seal of approval. The lesson we should draw from here is that of compatibility and evolution. Let me explain this. The traditional Buffett approach is not tuned to buying a stock that trades at a rich price-earning ratio of 80, 90 or 100, which is where Amazon was in 2019. So that's where a bit of the incompatibility comes in. And when we add to this the fact that Buffett turns a blind eye to technology companies as they are not within his circle of competence, then it's not difficult to understand how costly that error of omission can be. Now, in the case of Amazon, this counts for billions of dollars in lost opportunity. And so, while it is good and important to have a circle of competence, it is even better to evolve and to expand that circle over time. The Berkshire Hathaway portfolio does not include any Alphabet or Google stock, and this is something that Mr. Buffett deeply regrets. Google first caught Buffett's attention because of a Berkshire-owned subsidiary. You see, Geico is in the auto insurance space and relies heavily on Google's advertising platform to acquire customers. In numbers, the company was paying about $10 for every click on a Geico ad, while Google's cost of goods was zero, making it a high profit margin business for the tech giant. Buffett admits that by virtue of him being a customer of Google's ad business, he should have tried to make better sense of the company's business and outlook over the long term. In our view, it was again Buffett's limited technical knowledge which might have contributed to this missed opportunity, although in this case, the opportunity was right under his nose. While this might come as a surprise, Warren Buffett's biggest investing mistake was one of his earliest ones, which was the purchase of Berkshire Hathaway in 1962. At the time, Berkshire Hathaway was a failing textile business, but nevertheless it qualified under the classical Benjamin Graham model of identifying cigar butt businesses. This favorable financial evaluation got a young Warren Buffett interested in the company, and he started buying the stock in tranches. Then in 1964, the owner of the firm, a person named Seabury Stanton, offered to buy out Buffett's shares at $11.50, to which Buffett agreed. But when the offer letter did come in, the offer price had been written down to $11.32, which infuriated Buffett, who went on to purchase a controlling stake in Berkshire Hathaway and subsequently fired Stanton from the company. So while Buffett got his revenge, he was left holding a major investment in a failing business, to which he until this day remarks that it was the dumbest stock that he ever bought. After all, for the wonderful capital allocator he is, Buffett carried this burden of a failing textile business for 20 additional years and admits that if he had put in the cash flows to other businesses like the insurance business, then Berkshire would have been twice of what it is now. By his calculation, Buffett's purchase of Berkshire Hathaway was a $200 billion mistake. And the lesson for us is that being emotional does not help in investing, and what really helps is to have an unbiased mind and sound logic. And with this, we come to the end of this video. The fact remains that Warren Buffett is a human like all of us and has had his fair share of mistakes. In this video, we picked up 7 of his bigger ones, and hopefully you have learned something new in the process and will look to avoid these blunders in your own financial journey. If you liked this video, then do tap onto that like button, do subscribe to our channel, and don't forget to tell your friends about this video. Thank you for your time. I look forward to catching up with you next week over another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.